On this YouTube channel, we've been calling for a short-term market top, and it looks like that's maybe exactly what we've gotten. Ever since March 28th, the S&P 500 is down basically 4%, which is already almost halfway to correction territory. Remember that a correction is when the stock market goes down by 10% or more. This has happened in the snap of a fingers, and I know we have the benefit of hindsight now, but it's true. Me and you guys watching this video, we anticipated this. We looked at the fact that ever since October 27th, the stock market was up basically 28% in 5 months. Remember, typically we can only expect 7 to 8, maybe upwards to 10% on average return in the stock market every single year, every 12 months. The stock market did 28% in 5 months. And at the top of the market, when we started to anticipate, okay, we might be getting a little ahead of our skis here, it was when investors in the stock market were pricing in 5 or 6 rate cuts for 2024. We were very quick to push back on that. Why would we need 5 or 6 rate cuts when our economy is strong, the labor market is strong, the Fed is winning the battle against inflation, and people are getting rich? The only thing that cutting rates 5 or 6 times would do would be it would cause a huge stock market asset bubble where everybody got super rich over a short period of time, and then we felt pain for 12 to 24 months after the asset bubble popped. I mean, just look back at the tech bubble. That was what we were trending towards if the Fed truly did cut rates 5 or 6 times. We've been on board with 2 rate cuts maximum this year, all taking place after the November election, and it looks like the rest of the markets are starting to catch up to us in that thinking. I've been on record saying I don't think the Fed should cut rates at all, but 1 or 2 I don't think has much impact. Now, I do want to highlight really quickly, not to brag or boast about it, but to give you guys some background and to kind of take everything I say with a grain of salt today. We also called the exact market bottom at the end of 2022. You can go back on my YouTube channel and watch those videos of my thesis as to why I thought it was the bottom. Played out perfectly, and it looks like, again, we've timed the top perfectly. The reason I'm saying this, again, is not to brag or boast, but it's to tell you that more than likely the stock market is going to humble me. And I'm going to be wrong here very, very soon, because that's what the stock market does. Anybody that thinks they have it all figured out, the good Lord tells them, you don't know anything. Get ready, right? So take everything I'm about to say today with a grain of salt, but I will be giving you my thoughts and my opinions on where the stock market is going to go from here, how long this stock market correction or crash could last, and finally, when I will start buying stocks again, because I think every single crash, correction, or dip we get short-term will be a phenomenal long-term buying opportunity. Really quickly, if you're new here or returning and not yet subscribed, please subscribe down below. We have one of the fastest growing stock market YouTube channels out there on this platform. We have an amazing community. You guys that show up to watch my videos every single day, it means so much to me. I'm eternally grateful, but without further ado, let's get back to the video. So to set the stage for this, we kind of have to talk about the reasons I thought we would find a top. And yes, it had to do with investors getting way ahead of their skis with this rate cut talk, but it also had to do with investor sentiment being at or above 2021 levels. When the stock market topped in 2021, investors everywhere were bullish, and a lot of people don't realize this, but based on different measures, different surveys, different research groups, and different data points, most of them point to the fact that we were at least at the bullish levels of 2021 just recently, and many of those data points suggest that we were above that level of bullishness. Another thing we pointed to was valuation metrics and how valuations were getting very stretched, and people were starting to count on multiple expansion to see the stock market go up rather than earnings expansion to see the stock market go up. A very healthy bull market is one in which earnings go up, not multiple expansion, because multiple expansion is actually indicative of a topping of the stock market, because instead of people looking at the overall health of these companies, they start looking for justification as to why something should be valued so expensively. And usually it's looking at other companies that are valued so expensively and saying, well, just because they're valued this way, it means this company's undervalued because the valuation multiples aren't the same. Well, that is very unhealthy buying behavior, and ultimately, that does lead to a market top more times than not. We also pointed out oil prices, which is the chart on the screen here, and how it looks poised to reclaim $100 per barrel or higher as a result of A, geopolitical tensions, and B, the global economy bouncing back. I think I saw a headline just this morning. China's GDP grew at more than 5% in the most recent quarter. The global economy is waking up, and that's going to increase demand for oil and gasoline and diesel and all of these different inputs to the overall global economy, sending prices higher. And then we pointed to the fact that as a result of commodity prices being at all-time highs for the most part, inputs of our economy were going to increase in price, which means inflation is going to be sticky. When the inputs of our economy go up, the outputs generally follow suit, which makes the last mile with inflation a really hard battle to fight. And over the past few months, we've kind of seen this in inflation data, whether it's the CPI or the PPI. It's been trending upwards. And there were other various things we've been pointing out. I won't go over all of them in today's video to save you the time, but I think it all boils down to we anticipated that there would be a huge mindset and sentiment shift from how many rate cuts are we going to get in 2024 to, are we going to get rate cuts at all? And that's something that not a whole lot of people out there, in fact, I'm the only one out there that I think saw this coming, that I've seen, that really started to factor that in. Think that that was possible, that we might begin to question if we're going to get rate cuts at all. And it's paid off big time. Again, we've been in cash build mode for a couple months now, and we're just going to be buying this dip. Any correction or crash that we get, boom, 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 money printer, pile it in because it's a long-term buying opportunity. So let me discuss this. How long do I think the stock market crash or correction will last? I think we will see a 10 to 15% correction by the time this is done. Don't get scared though, because I'll explain to you why this is going to be a buying opportunity in my personal opinion. But today we actually broke below the 50-day moving average on the S&P 500, which means next up is the 200-day moving average. The S&P 500 always has a tendency to correct back down and normalize. It's just the law of averages. Our stock market started to get way stretched above our 200-day moving average. And just like has happened throughout all of the history of the stock market, things will meet up again. The stock price of the S&P 500 and its 200-day moving average are going to collide at some point in time. And it just so happens that if we get a 10 to 15% correction, we're going to be sitting at the 200-day moving average. This means that the SPX, the S&P 500, will go down to 47, maybe 4,800 before it finds a bottom, if my thesis here is correct. Now, why am I bullish on this just being a short-term correction? Well, it's because if you think back to everything I've mentioned, none of it impacts the economy. Sure, we're going to be higher for longer with interest rates, but you know what? Interest rates at 5% have just normalized. Interest rates at 5% are hardly restrictive to the economy. If you don't believe me, look at asset prices everywhere. Everywhere. Real estate, land, Bitcoin, the stock market, you name it, all-time high. What that tells you is there is a lot of liquidity in the system and that financial conditions are not tight whatsoever. And this was part of my thesis at the end of 2022 when nobody wanted to buy stocks. I believed that our economy would be able to perform greatly even at interest rates of 5%. And I believe that company earnings could perform greatly even at interest rates of 5%. We've proven already that our economy can withstand 5% interest rates. Don't believe me? Here's another thing you can look at. The small business survey from the NFIB, where they survey small business owners and ask them what their most important problem is. You might think, they're probably going to say interest rates. Nope. Only 4% of respondents of this survey, it's this purple line here at the bottom, only 4% named interest rates as their biggest problem. And these are small businesses, the businesses that are most impacted by interest rates. Only 4% of them see interest rates being their biggest problem right now. That's more evidence that interest rates aren't hampering our economy. Sure, there's pockets of our economy that are feeling pain, but a lot of it is actually because we got too stretched out. Companies, businesses got ahead of their skis coming out of the great financial crisis. And so we're just going to cut the fat off the economy. That's what interest rates have done. Sure, there's going to be pockets that feel pain. We've been big subscribers of this rolling recession theory where, yeah, the goods sector of our economy in particular has been going through recession, but we now think it's bottomed. At least I think it's bottomed. And you know what? If the goods recession has bottomed and that rolling recession turns into a rolling recovery, that's going to be another boon to our economy. Our economy is going to remain very strong. We had retail sales numbers come out the other day. And as a result of the strong retail sales numbers, the Atlanta Fed's GDP Now tracking model revised their GDP estimate up to 2.9% from 2.4%. Our economy is flying high, and nothing is slowing this thing down. None of those factors, bullish sentiment in the stock market, valuations in the stock market, interest rates being higher for longer, none of that impacts our economy. All it does, if it corrects, is it takes the froth out of the stock market. All of these people that were piling into shit coins and all these people that were trying to find the next penny stock, those people are going to disappear again. They're going to get fearful when the underlying backbone of the stock market, the economy, company earnings are performing great. And you know what? Yeah, I believe we've gotten a little ahead of our skis with the whole AI craze as well. But it's just going to be another boon for our economy. Over the next decade, AI is going to benefit our economy tremendously when it comes to discretionary income, the amount of money people are able to spend, because incomes will go up as company margins expand, and company margins will expand because they're becoming more efficient as a result of artificial intelligence. So the backbone of our stock market is very healthy. We have a very healthy economy, and none of the factors I've laid out are going to slow down this economy. And I can't identify a single catalyst at this point that will slow down our economy. And just another thing we can point to is the fact that baby boomers, the people retirement age or older, are retiring with a total net worth of $76 trillion with a T. $76 trillion. And those people are spending their money in the economy. When you go out to a restaurant, what do you see? You see gray hair everywhere. People are spending their money and they're cooking less at home because the kids are out of the house. They're going out to eat. And ultimately, that's another reason our economy never saw a recession. This highly anticipated recession never happened because baby boomers were so rich and they were spending their money. And that's something that economists have kind of ignored for a long time now. And hopefully they wake up to this now. They ignore demographics. So I guess what I'm trying to say is no bear market or correction or crash lasts very long when the economy is strong and growing. So any short-term correction we get, unless the economy really starts to fade, which I guess is possible, I don't think it's very likely at all, but unless that happens, every single dip we get is going to be a good buying opportunity. And you're going to see me, again, I've done this in the past. I'll be buying stocks when nobody else wants to buy stocks. I'll be out there doing it. And you guys can follow along if you want to. If not, whatever. So short term, what do I see happening? Yeah, I think crude oil will reclaim $100 per barrel. It's going to add fear to our economy. But you know what? I've talked about inflation rearing its ugly head, I guess you could say. Rearing its ugly head again for a second time. Kind of having a second bout of inflation. Well, oil prices are going to drive that, but you know what? The Fed can't control oil prices. The Fed can't control commodity prices. The Fed, the sticky parts of our inflation reports have been like health insurance. Does the Fed have any control over health insurance rates? Not really. Not really. So yeah, I think investors are in for a rude awakening that it's not going to be sunshine and rainbows. We're not going to form a huge asset bubble like we thought was possible. We're going to kind of have to hamper investors' expectations here if we want the stock market to go higher. I also think that the 10-year Treasury yield will trend towards 4.75 to 5.00%. I talked about that in a write-up in my members-only Discord server. And yeah, if that happens, more money's going to come out of the stock market because it's another alternative that you can get risk-free yield on. If that risk-free yield rises naturally, people have different risk tolerances. Some people are going to take their money out of the stock market and put it into a risk-free yield. But again, do any of these things really affect our economy long-term? No, they don't. If interest rates stay the same, we've already proven our economy can withstand it and really grow strongly. Not even just withstand it. Our economy is performing tremendously with interest rates at 5%. And I think it would be a big mistake if the Fed did cut rates. So I hope they don't. But Again, 1 or 2 rate cuts, it really won't make a huge difference. I'm just glad we're not going to see the 5 to 6 rate cuts. So I'll mention just a few things that I have been buying recently. It's Tesla, because I think Tesla is at incredible value right now. I think it's very undervalued. Nobody else wants it, and that's exactly when I want it, because I think Tesla is going to be the most valuable company in the world someday, and it just went below a $500 billion market cap today. I'm buying Tesla. I've also stated in the past that it might be smart to get some oil or energy exposure in your portfolio to serve as kind of a shock absorber if geopolitical tensions rise or if the global economy starts to bounce back. That's been a really good move, and I think it'll continue to be a good move if oil prices trend higher like I think they will. And then lastly, I haven't been buying, but I don't think it's a bad idea to buy. I'm just simply not buying because it's already such a large percentage of my overall portfolio. Bitcoin mining stocks, Bitcoin itself. I'd be buying right now. It has a unique catalyst that's going to take place in 3 days, the Bitcoin halving event that only impacts Bitcoin and its derivatives. It has no impact on the overall stock market. And ultimately, Bitcoin, I believe in it long term, and I think I'm getting a really good deal if you have a decades-long investment time horizon on Bitcoin. So I'm not just going to wait and plan on Bitcoin going down to buy. But with that, let me know down in the comment section below something you're buying, and also let me know your thoughts on my video today. If you agree with me, if there's certain points you disagree with, let me know down in the comment section. I love having that dialogue. I think it makes us all sharper. And again, if you want access to my buy and sell alerts, my macroeconomic analysis, my price target spreadsheets, things like that, you can join my membership by hitting the join button located right next to the subscribe button, or hitting my Patreon link in the pinned comment. I never take paychecks from companies. I never have done sponsorships. I never will do sponsorships because I want to be self-funded. I want to be independent. I don't want anybody dictating what I can say. So your monthly support through that membership means a lot to me. So consider doing that if you're a fan of this channel. But with that, hope you have a great rest of your day. Stay blessed. Keep 10 toes to the ground. Your chin up. Peace out.